Hello students, I am Vipul Mittal, and in this session I will discuss accounting and reporting for assets classified as held for sale. So here we are talking about long-lived assets. You know what are long-lived assets? Benefits from such assets extend to more than 1 year. So you get benefits from those assets for a period of time that is more than 1 year. Long-lived assets, for example, building, machinery, equipment, furniture, land improvements, land. All those are long-lived assets. You get benefit from those assets for more than 1 year. Now, a long-lived asset may be classified as held for sale and held and used. So a long-lived asset that is not classified as held for sale is classified as held and used. Held and used is more of a residual classification. So you check that, okay, whether an asset or a group of assets can be classified as held for sale. If it can be classified as held for sale, fine. If not, it is held and used. Now, an asset that is to be sold should be classified as held for sale if certain criteria are met. So there are 6 criteria, and all those 6 criteria must be met that you may classify an asset or an asset group as held for sale. There are 6 criteria. So a long-lived asset or an asset group is classified as held for sale if certain criteria are met. So we are talking about a long-lived asset that is to be sold, but 6 criteria must be met regarding that asset. First, there is a plan to sell that asset, and management commits to that plan. There is a commitment from management towards this plan. Management commits to a plan to sell. Second condition is that it is unlikely that plan will be withdrawn. There is a possibility that plan will be withdrawn or plan may be withdrawn. But what is that possibility? Unlikely. So it is unlikely that plan will be withdrawn. Or any changes to plan will be made. Significant changes to the plan will be made. It is unlikely. So the possibility that plan will be withdrawn or possibility that significant changes to the plan will be made is unlikely. This asset is available for immediate sale. In its present condition. So this asset is available for sale in its present condition. Very important condition. If it is not available for immediate sale, then you cannot classify it as held for sale. It has to be classified as held and used. Although you plan to sell, but since it is not available for immediate sale, you cannot classify it as held for sale. This condition is not met. For example, you currently occupy a building and you plan to sell this building. When? When another building that is under construction is complete. So you will vacate this and move to new building. So when construction of this new building is complete, you will vacate this and move to new building. You have a plan to sell this old building. But you do not intend to vacate it right now. You cannot vacate it right now. You will not vacate it right now. You will vacate this when construction of this new building is complete. Okay. So we are talking about this old building. You have a plan to sell this building. Can you really classify this as held for sale? Answer is no, because this old building is not available for immediate sale. Now, fourth condition, that you are actively looking for a buyer. The entity is actively looking for a buyer. And this asset is marketed at a price that is reasonable. So price is reasonable. You're not asking an unreasonable price for this asset that sale is difficult. You are asking a reasonable price. This asset is marketed at a reasonable price, considering its fair value. And the last condition is that the sale is probable. And transfer of asset will happen within 1 year. You also call this 1 year requirement, that sale is probable. There is more than 50% chance that sale will happen and transfer of the asset will happen within 1 year. That is, sale will be complete within 1 year. So these criteria must be met that you may classify an asset or an asset group as held for sale. There is a plan to sell. Management commits to that plan. It is unlikely that plan will be withdrawn or significant changes to the plan will be made. This asset is available for immediate sale. Entity is actively looking for a buyer. This asset is reasonably priced, marketed at a price that is reasonable, and sale is probable, and transfer of asset to the buyer will happen within 1 year. 1 year requirement is met. When these six criteria are met, you classify the asset as held for sale. And when you classify an asset as held for sale or classify an asset group as held for sale, it has accounting and reporting implications. Let's discuss those. All right. A long-lived asset or disposal group classified as held for sale should be measured at lower of its carrying amount or fair value less cost to sell. So we are here talking about balance sheet implications. So it should be classified as held for sale on the balance sheet and measured at the lower of its carrying amount or fair value less cost to sell. So lower of these two, carrying amount or fair value less cost to sell. Now, cost to sell, you include brokerage, legal fees, commission, transfer fees, the cost that you incur to sell. So a long-lived asset or asset group or a group of assets and liabilities. This is a group of assets or and liabilities that is classified as held for sale is reported on the balance sheet under the head held for sale. So properly classified and presented on the balance sheet and measured at the lower of its carrying amount or fair value less cost to sell. An entity should recognize the loss for any write down of the assets or disposal groups carrying amount to its fair value less cost to sell. All right. So in case fair value less cost to sell is lower than the carrying amount, then you report it at fair value less cost to sell. When you report it at fair value less cost to sell because it is lower than the carrying amount, what it means? It means that you are reducing the carrying amount. You are writing off the asset. So there is a loss on classification. Why? Because you are reporting it at a lower figure that is fair value less cost to sell. So you have this loss, that is loss on classification. And what is this loss on classification? Carrying amount minus fair value minus cost to sell. And this is reported in income from continuing operations, this loss. And this loss you have only when you are reporting at fair value less cost to sell. Why you are reporting at fair value less cost to sell? Because fair value less cost to sell is lower. In case carrying amount is lower than fair value less cost to sell, then there is no loss on classification. Because carrying amount is lower than fair value less cost to sell. Because carrying amount is lower, you report it at carrying amount. You do not need to recognize any loss. There is no write-off. There is no loss on classification if you are reporting it at carrying amount. Let's take an example. It is December 31st, year 6, and carrying amount on that date is, let's say, of this asset is 800,000. This asset is held for sale. This asset is to be sold, and those 6 criteria are met. All right. You also know the fair value of the asset on that date. It is $740,000. And you have cost to sell. It is $40,000. All right. And then you have fair value minus cost to sell. It is $700,000. On December 31st, year 6, you report this asset as held for sale. When it is reported as held for sale, you report it at a lower of carrying amount or fair value less cost to sell. In this case, fair value minus cost to sell is a lower figure. This $700,000 is lower than $800,000. On balance sheet, you report it at $700,000 held for sale asset. What about income statement? Because you are reporting the asset at fair value minus cost to sell, you have loss on classification. And it is carrying amount minus fair value minus cost to sell. How you record this? Loss on classification debit and asset credit. $100,000. Once you classify an asset as held for sale, don't depreciate or amortize that asset. As long as it is classified as held for sale. So you classify an asset as held for sale. The moment you classify, stop depreciating that. When you classify, you report this asset on balance sheet at a lower of carrying amount or fair value minus cost to sell. Okay. If fair value minus cost to sell is lower than the carrying amount, you report a loss on classification that goes to income statement. All right. As long as it is classified as held for sale, don't depreciate or amortize. So while it is classified as held for sale, don't depreciate or amortize. I hope this session was helpful. We'll connect again. Goodbye.